Lyn Alden exposed US Fed and top banks' losses of amount of cash. So what we're basically seeing now is the Empire Strikes Back, right? And so if anyone has seen the Star Wars trilogy, the original one, you had the initial movie and then you had a response to that, right? So if you look back in the past couple of years, we had this gigantic inflationary response. We had all these like speculations and things like that. And now we have a variety of central banks around the world, mainly the Federal Reserve, trying to fight back and regain some degree of like a stability with their currencies, and the problem is that they're about 2 decades too late, right? So a lot of these seeds were set in like the Greenspan era, the 90s, the 2000s, but nonetheless, it was super high debt to GDP ratios. They're now trying to fight back and regain some nuclear currency stability, and that's causing massive volatility in financial markets, and specifically sovereign debt markets, because that's ultimately the limiting factor when you get to the end of the road in terms of kicking the can down the road. So we've had 4 decades of structurally declining interest rates. Little cyclical rises, but mainly it's structurally downward, and that allowed for all this debt accumulation and asset price of appreciation as well, because if you were measuring a stock valuation based on a 7% treasury yield, you might want an 11% return, for example, like maybe you want a 4% equity return premium over that treasury. But if treasuries are 0% or 1%, you might want a 5% equity return because you still want a 4% equity return over that treasury. And so you're willing to pay a higher valuation due to TINA. There is no alternative, right? And so you had 4 decades of declining it. Trades and higher real estate and equity valuations, and the problem is when you run into the zero bound or slightly below it, and then you also run into an energy crisis. So we go through these historical cycles of underinvesting in commodities and especially energy, and then you get inflationary pressures from that supply situation which have been exacerbated but at this cycle by ESG and other things like that. But nonetheless you have that combination of super high debt, zero or sub-zero interest rates, and then real world constraints. Now you're into a prop. Now you have industry that's going sideways to up, and then this you're mostly up, and that puts a lot of pressure on the whole system, right? So all those like dollars, like you had $1 in your brokerage account. Based on your stock valuations, you had dollars in your bank account. You had dollars in your your treasury bonds, and all of those were supposed to represent claims for real world resources, right? But when the cost of those resources go up and then the valuations of those financialized, second, third, fourth layer derivative assets start to go down, it turns out that the vast majority of those claims are not really worth, the real world resources that they thought they were, especially if a significant portion of the population tries to call them in at once. And that's essentially what we're going through, and that's what we go through in every kind of generational, disinflationary to inflationary cycle historically. So indirectly, I think we can separate the problem into the proximate cause, meaning like the immediate cause, and like the core underlying costs. And so the core underlying cause is weak money. If you have weak money, artificially low interest rates, currency, they keep devaluing, there's a very strong incentive to borrow money and buy hard assets, right? And so that's the structure we've been in for 40 years. Now, the proximate cause is when some of those things start to blow up. And so we had a bunch of proximate causes back in the 2008 crisis, and now we're getting another wave of those. And for example, UK pensions, which are the most, kind of newsworthy, they had a variety of, programs in place where they would use their UK government bonds as collateral to own derivatives that allowed for a smoother payout. And it's less so about speculation in a sense. They were trying to juice returns like the degenerate trader, and more so about trying to smooth their returns, knowing that they as a pension have a very well telegraphed and known liability payout ratio. Month after month, year after year. And so they're essentially paying for volatility production, and they're basing this on models that government bonds may fall, but they can only fall by so much.